Form is temporary, but class is permanent. Now, this would be an apt description for India's largest FMCG firm, Hindustan Unilever. Despite a muted show in the fourth quarter amid inflationary headwinds, the analyst community's love affair with the market heavyweight has only increased. On the other hand, you have its more diversified peer, ITC, that has posted stellar numbers on the back of strength in both cigarette and staples business. Now, this cigarette to hotel major has more earnings visibility than its peers, which is why it features in most market participants' buy lists. But is there a case for choosing one over the other? Or does an ideal portfolio need the twin engines of both ITC and HUL? Well, in this video, let's take a look at how these two stalwarts stack up and if there is a case to pick one over the other. But first, don't forget to like and share this video and subscribe to the Moneycontrol YouTube channel. Now, when it comes to financials, HUL's fourth quarter numbers were marginally below expectations on most fronts, but it was the volume growth of just 4% which disappointed the street. In fact, the 3% contraction in rural volumes accentuated the underlying pain points in the economy. Now, most analysts expect the trend to continue in the coming quarters. But there are no such issues where ITC is concerned. ITC's FMCG business posted impressive figures on both growth and profitability fronts. Cigarette volume shot up 12% on a year-on-year basis. In fact, cigarette business was also aided by a clawback from illicit trade, while the hotel segment was lifted by the post-COVID revival in travel, which offset the weakness in paperboard and agri-businesses. Let's now take a look at how the stocks have performed. ITC shares have been hogging the limelight since the past year and in fact has been consistently hitting fresh 52-week highs in recent times. HUL's performance, on the other hand, has been sedate in comparison. However, on a 5-year basis, HUL has given better returns than its more diversified peer. And now coming to what the street verdict is looking like when it comes to the top two FMCG heavyweights. Now, there's very little to choose between the two, as both companies feature prominently on buy lists. With zero sell calls, ITC has a near perfect score on the sentiment meter. But even HUL has reasserted its position with an increase in buy ratings post the fourth quarter numbers. Centrum Broking is cautiously optimistic when it comes to HUL. The brokerage expects mid-single volume digit growth as the near-term operating environment continues to be challenging. It has trimmed its earnings estimates and retained ad rating on the stock. Meanwhile, Motilal Oswal feels ITC's earnings visibility is better compared to peers. It also adds that key challenges for the company, including COVID disruption and commodity cost inflation, now seem to be receding. Let's also take stock of the valuation picture. Mirror, mirror on the wall, which one is the cheapest of them all? Well, HUL has traditionally commanded a higher price multiple than ITC, in line with most consumer staple firms. At a 1-year forward PE of 52.69, HUL is trading well above its 10-year average of 46.5x. But ITC's price multiple of 25.4x is also above its 10-year average of 22.16x. Incidentally, ITC has among the lowest PE ratios in the Nifty FMCG index. Now, this is mainly due to the tax overhang on cigarettes, though the situation may be turning favorable for the company. However, analysts say that ITC's recent run-up limits its further re-rating potential, which means that the PE gap with HUL is expected to remain in the medium term. Well, that's all from us, but for more such videos, stay tuned to Moneycontrol.